Good morning, class. Today we're going to be touching on a new lesson, which is the share capital, again relating to your company accounts. What is a share capital? In the previous recordings, you heard me talking about shares, and as I told you, that shares is the amount of money. It is the amount of money which the investors invest into a company, and in return they get the share certificates. So the money you invest in a company becomes the share capital. The person who invests the money becomes the shareholder. So share capital is the capital of the company, which is divided into shares, which are then bought and owned by the shareholders. Now there are two main types of share capital, which we will be looking into today. The first one is the authorized share capital. Authorized, as it says authorized, it means this is the maximum share capital that a company is allowed to issue, also called as nominal capital. So by the registrar of the companies, each company has a specified limit as to the number of shares they can issue. So the limit you have, you only need to stick to that limit. You cannot offer more capital to the company than you have been authorized. You cannot offer more shares to the public than you have been authorized to do so. So next is your issued share capital. What is issued share capital? Issued share capital is simply the amount of capital which the company has actually issued out of their limit of authorized share capital. So issued share capital is going to be a subheading under the authorized share capital. Authorized share capital is the maximum amount, the maximum limit a company can offer to its prospective investors. That is the maximum limit a company is allowed to gather as capital from the public. And issued share capital is the actual amount of shares the company has issued out of their authorized share capital limit. So let's say the authorized share capital is a company is allowed to issue $500,000. And out of the authorized share capital, the company actually ends up issuing 200,000 worth of shares for now. So it means out of the total limit of 500,000, you have only issued $200,000 till now. So you still have a limit of 300,000 to go. So that 300,000 can be utilized in any point in time. Whenever the company requires more funds, you can start issuing more shares for the company and people will start investing. But remember, you cannot exceed the limit of your authorized share capital. It's not allowed, it's against the company law. If all the authorized share capital is issued, let's say out of 500,000 you issue the whole 500,000, then 1 and 2 are the same. Authorized and issued become the same because you've reached your limit. So these were the types of share capital. Now moving on to shares and dividends. Okay, the share capital is now further divided into two types. There are ordinary shares and there are preference shares. Now ordinary shares are what? This is the most popular way of raising capital. Ordinary shareholders, that is the people who are investing money in ordinary shares of a company, will receive a variable amount of profit. Hey, why do you invest in a company? What is the point of investing your money into someone else's company? You invest money in order to make a profit. So ordinary shareholders receive a variable amount of profit. It means their profit is not fixed each year. And the amount of profit they receive, we call it as dividends. So dividends is the amount of profit you are receiving on your share capital. If a company makes a loss, then no dividends are likely to be paid. It means that once a company is into losses, obviously the company does not have extra funds to distribute as profits, as dividends. Hence, your ordinary shares are riskier than your preference shares because ordinary shares get a variable amount of profit. Maybe the year you have higher profits, higher dividends. The year company makes low profits, low dividends. The year company makes a loss, no dividends. So, it is a riskier investment than the preference shares. Now, which brings us to our second type of shares, which are preference shares. Now, what are our preference shares? First thing is understood that they are less riskier than the ordinary shareholders. Now, preference shareholders get an agreed percentage of dividend. It means their percentage rate of dividend, that is, their amount of profit, is not variable. It is agreed upon and it is a fixed percentage rate. So let's say I have preference shares worth 200,000, and on 200,000 worth of shares I will get 20% dividends every year. So whenever a company makes a profit, I will only get 20% out of it, because my preference shares are of an agreed percentage. They will be paid this amount before the ordinary shareholders. So why the name preference? It means their preference is over the ordinary shares. They are given preference over the ordinary shareholders. So they are paid before the ordinary shareholders. They can attend the annual general meetings but have no voting rights. Remember, ordinary shareholders have a voting right, because once you buy a share, you become the owner of the company. But preference shares and ordinary shareholders both are owners, yet the voting rights, the decisions of the company only reside with the ordinary shareholders, not the preference shareholders. So they can attend the meetings, the general meetings the company holds annually, but they cannot vote in on it. Okay. So what do you think is the difference between two? Who is better off? Now this depends on your mentality. If you are risk averse, that is, you want to avoid risks, then risk averse person will invest here. Invests here. But if you are a risk taker, you like risks, then risk takers invest here. Listen, remember, with ordinary shares, yes, these are risky, but in case a company makes high profits, it means in that year or those years, you will earn higher amount of dividends, which is good. But in a preference share situation, if you are a preference shareholder, then even if the company is doing brilliantly good, they are making huge amounts of profits, even then you will not earn more than your agreed percentage. Your rate of dividend will remain fixed. Maybe the ordinary shareholders are getting more than you. It can be a case in times of good performances. So this is the difference between ordinary shareholders and preference shareholders. And dividends payable. What are the dividends payable? A successful company, I missed the word company here. Company is likely to pay a dividend based on its net profit. It is, however, unlikely that all the profit will be for distribution, since company may retain a proportion in the form of revenue reserves. Students, if you remember, I told you in the partnership chapter as well that once a company makes a profit, it is not its responsibility to hand out all of that profit to the owners, the partners, or in this case the shareholders. Because how do the companies expand? Companies expand by making more profits. So when you make a profit, you invest it back into your business in order to expand your operations. So the amount of money out of the profits which is invested back into the business, we make it a part of revenue reserves. What revenue reserves are, we'll come back to it later in greater detail. For now, all you need to know is understand the difference between ordinary shares and preference shares. Thank you for now. See you tomorrow.